Hi, folks. Welcome back to the Money Wisdom Podcast, powered by Johnson Brunetti. I'm Nick Colantuono, certified financial planner up here in our Boston offices. As always, joined by my colleague, Jake Dozer, down in our Connecticut offices. Jake and I are both certified financial planners, and we are glad that you are back joining us again on our Money Wisdom Podcast series. Today's question is actually from a listener of ours up here in our Boston area. This comes in from Paul. Actually, Paul in Newton. So, Paul, if you're out there listening, thank you for the question. I'm sure you are listening, or else you wouldn't have known to send a question in. So, folks, that's me teeing it up. If you've got some questions, if you've got some concerns, send them our way, email them to us. We would love to address them on this podcast. We are in the business of helping people. So, Paul says, I'm 74 years old and I'm still working, making about $150,000 a year. He's got over $1 million in his 401k. Which he hasn't started to take distributions from since he's still working. So again, folks, 74 years old, over required minimum distribution age, but again, continuing to work, so that money does not have to come out. He goes, however, when I retire in a couple years, I'm thinking that my RMDs are going to be massive. They probably will, Paul. Anything I can do now to start planning for it? So Jake, a lot to unpack there, a lot that we see pretty much every day from folks looking to get addressed. But give us a little bit of your insight when it comes to Paul's situation. What should he be thinking about kind of before anything?
Yeah. So Paul, Nick, as you mentioned, is 74. So that means he's 1 year following the year of RMDs. As he mentioned, RMD is a required minimum distribution. And so that means that at age 73, the Uncle Sam says, hey, I haven't gotten my hands on the taxes from your pre-tax monies yet, because you've put money in and deferred taxes till later. And so now I want to force you to take withdrawals so I can get the taxes from it. That's the government for you. And so his challenge is that, hey, I've got all my money in this pre-tax bucket and I'm about to be potentially hammered in RMDs, forced to withdraw money beyond what I actually need. And that's a tax problem. It's a good problem, but it's a tax problem. It's an asset problem because, now your assets aren't growing as well as you'd like because you're being withdrawn from, et cetera. And so the first few questions is we need to understand, number one, how do we set you up in a position where you're not building this problem even further? So one of the things I might be looking at to say is, Paul, should you consider now doing Roth contributions to your 401k? A Roth is obviously the inverse, where you're paying the taxes now so that you grow tax-free. And so in a 401k, a Roth, well, in any retirement account that is, a Roth IRA or a Roth 401k doesn't have required withdrawals. So if you switch your contributions going forward, that'll stop for that RMD number to keep building because your pre-tax money keeps building. Another thing we need to think about in line with that, in order to make an informed decision, is, are you single? Are you married? That'll dictate what tax bracket you're in, and if the juice is worth the squeeze on that, meaning should we do Roth contributions, or do you have too much income right now to do that? So that's one way we can stymie and stop the rising RMDs, is to look at that. We can also look at in-plan Roth conversions. Should you be considering converting your pre-tax money now into Roth so that your RMDs aren't higher? Number three, we should be looking at, are your RMDs really going to be that insurmountable? Maybe the withdrawals you want to take are in line with the required withdrawals that you would take otherwise. So that would be a third thing. Those are pragmatic, very in the weeds questions. But zooming out, obviously, the core of all this comes back to, what is the plan of attack here? Why are you still working? Is it because it's financially necessary? It's because you want to, et cetera. Nick, along those lines, what are the next types of things we should be looking at or questioning there?
It all comes down to how much you need, right? How much you need from an income standpoint when you're not working. And maybe for this individual, well, maybe Social Security, maybe there's a pension, right? We want to know, how much income does this individual need each and every month in a world in which they're not working? Because maybe continuing to make these 401k contributions, like you said, maybe that's only furthering this tax problem that already exists. So again, you have to know whether or not you should even continue contributing to retirement accounts. And I know it's kind of crazy for me to sit here saying, oh, you don't need any more retirement money, but the reality is maybe you don't. And if you don't, and if you don't need to just keep furthering that kind of ticking tax time bomb that lives within these 401ks and these IRAs, then that's where really I would recommend the conversation start. Because again, we're all doing what we were told to do. We're all putting money into those 401ks, into those tax deferred retirement accounts, because again, the old adage is you save it for a rainy day. Why pay the taxes on that money now when you're in your highest earning income years? Defer the taxes, let that money grow, let it compound. But nobody knows better than your good friend Uncle Sam that you've never paid a penny of taxes on that money before. So, obviously this individual is certainly thinking about this the right way, saying, okay, when I do stop working, maybe those distributions I'm forced to take, which in this case, if it's $1 million in a 401k, I mean, by the time he retires, that could be $40,000, $50,000 a year in taxable income above and beyond his Social Security, above and beyond any pensions, or above and beyond any other income streams that this person has. And if they don't need that much income, well, then maybe they don't need to keep funding that bucket, right? So again, it all comes down to just having a plan. And none of us don't know what we don't know, right? So whenever it comes to this, how do you know if you haven't gone through a process like what we provide to everyone who comes through our doors? That Money Map Retirement Review. It's a very involved look at the road ahead, not just from an income standpoint or an investment or an asset standpoint, but really from a cash flow and from a tax standpoint. Because again, if you think tax rates are high now, what do they look like 10, 15, 20 years from now, right? Where if all your money lives in these IRAs and these 401ks and these tax deferred buckets, where you're going to be paying income tax on that money for the rest of your life, if there's something there that we need to get out in front of, there's no better time than now to start thinking about it.
That you hit the nail on the head. And I think that all of it comes down to, this is a perfect example of income planning. Now, Paul, I know you're 74. It might feel like, oh my word, this decision is on my doorstep and it's too late for me to do anything about it. And don't get me wrong, the sooner you plan for this income conversation on how do I make sure that I'm not creating too much taxable income and instead creating other income that might be tax-free through a Roth or partially taxable through a non-qualified or non-retirement investment account. Those are ways that you want to be filling up these alternative buckets, and we would call that tax diversification. And so this is a twofold challenge. It's a good problem, but it's twofold. Income planning. So we need to go back and say, hey, if you're listening to this and you're not Paul, let's get ahead of this challenge. Let's make sure you're not in this situation, which again is a good problem, but you're not down the road with too much taxable income. Too much income is not a bad thing. Too much taxable income is a bad thing. That's how you don't not only pay your fair share, but you also leave Uncle Sam a tip. We don't want to leave him a tip. The second thing is income and the tax planning piece. So these two things go hand in hand. But income planning is, how much income will I need? How do I build my portfolio to create that income in the most tax efficient way and to make sure I never run out? And that's really the heart at what this is striking at. Paul, it's not too late. But if you're listening to this and you're before where Paul's at, let's get ahead of it and plan even sooner now. The sooner you plan, the better.
Are you ready to retire with confidence? Join us for our retirement planning workshop and learn strategies to maximize Social Security, healthcare, income planning, taxation, and more. Text workshop to 800-757-0436 to reserve your spot, or click the link in this week's show for more details on how to register.
Absolutely. And Jake, I think that's probably a good place to end this. I mean, the point being here, folks, so many people are just literally shocked when they look at the road ahead and they look at what their tax burden could be as a result of, as I mentioned, doing what we were told to do and saving for a rainy day. And, don't pay the taxes now. When you retire, you'll be in a lower tax bracket. But as well as I do, very few people actually find themselves in that situation. So, folks, point being here, come in for that conversation. We'll show you what the road ahead looks like. And if you don't know, well, then how do you know what to do to get out in front of those what ifs of the future? So as always, I'm Nick Colantuono, certified financial planner up here in our Massachusetts offices, joined by my colleague Jake Dozer down in our Connecticut offices. And again, we are Johnson Brunetti. So thank you as always for joining us on the Money Wisdom podcast. Keep those questions coming, folks. Thank you.
Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.